All right, good afternoon, everyone. This is Joe Bocelli here at Chaikin Analytics, and I'd like to welcome you to our presentation of Conquer Earnings Season and Profit from Earnings Surprises. Presenting today is Marc Chaikin, founder and CEO of Chaikin Analytics. As a reminder, this webinar is being recorded, and a copy will be sent to everyone who has registered. Please submit your questions throughout the webinar using the Zoom Q&A window, which you can access in the upper left-hand corner of your screen. Now, Marc Chaikin created Chaikin Analytics to put the power of proven stock research tools in the hands of professionals and individual investors. His latest contribution is the Chaikin Power Gauge Rating, a 20-factor model that uniquely combines fundamentals and technicals. To get us started, enjoy the presentation.
85% fundamental, 15% technical. And I created the model because self-directed investors didn't really have the tools and the discipline to successfully manage their own money.
And that's created by famous analyst and entrepreneur Marc Chaikin.
I'm a big fan of Marc Chaikin, though, so it makes me nervous, Scott, because I like his metrics of looking at the market.
Marc Chaikin.
Marc Chaikin.
An expert known on Wall Street for developing computerized stock selection models.
Joining us is Marc Chaikin. He is the founder of Chaikin Stock Research. Mr. Chaikin, welcome.
Thank you, Joe, and thanks to Jim Cramer and John Najeri and et al. We like to jazz things up a little in the beginning. We've been a beneficiary of a lot of good partnerships and media exposure, so we're going to try and share with you what got all those people so excited. And we're right in the heart of earnings season. This is the busiest week of earnings reports for the first quarter, 72 stocks in the S&P 500 report. And there's a lot of money to be made during earnings season, but people are pretty nervous because of all the volatility. And in today's webinar, we're going to try and show you how having a disciplined approach and the right tools can help you make big outsized profits during earnings season. This disclaimer is meant to tell you that we don't have any relationship with the U.S. or state regulatory agencies, and that any of the examples that we use in the webinar are for educational purposes only and not meant to be a recommendation. So why Marc Chaikin? For those of you who haven't been on these webinars before, I've been on Wall Street for 50 years. I've been using technical analysis for 45 years in conjunction with fundamental analysis. That's what this webinar is really going to focus on, how fundamentals are important, and we give you the tools to know what the fundamental potential for a given stock is. I headed the options department at a regional firm called Tucker Anthony, so got to see tens of thousands of options traders in action, and I can tell you that it wasn't pretty. In spite of all our good efforts to educate them and bring them the right tools, options traders in general lose money. So for those of you on the webinar today, you're going to see some disciplined ways to use options during earnings season that will turn the odds in your favor. Almost from the beginning of my career on Wall Street, I was intrigued by the concept of earnings estimate revisions and earnings surprises. When information was hard to come by, if you could get a sense of what companies were actually reporting better than expected earnings, and it wasn't easy back then, you really had a window into profitable opportunities, not just as earnings were being reported, but for 4 or 5 weeks going forward. And that's still the case today, believe it or not. Along the way, I've been mentored by some of the smartest and most successful institutional investors. Some of them were colleagues, some of them were clients. And the reason that's important is because what I learned from them is reflected in the Chaikin Power Gauge Rating, which we're going to go into in depth. It's really our go-to fundamental indicator. It's the centerpiece of everything we do here at Chaikin Analytics, and it's the culmination of my life's work. So I'm very pleased to be sharing this with you. As I said, we've gotten the benefit of a lot of exposure in the media on CNBC, and also partnering with people who in their own right are successful. John Carter at Simpler Trading, John Malden at Malden Economics. And our tools are now being used by some of the institutional investors that we used to deal with back in the 90s. Paulson Hedge Funds, Soros, fund management, Fidelity Investments. So what we're going to be talking to you about today are tools that institutions are using that we've taught to institutional investors for many, many years. And what we're going to be looking at are the keys to conquering earnings season, showing you how to find bullish and bearish stocks to trade, how to anticipate future price movement using Chaikin Money Flow, how to improve your timing with buy and sell signals, and using our earnings alerts and our earnings surprise indicators with options to supercharge your profits during earnings season. I'd like to start the webinar by asking you to look inside yourself and see if something's really been missing in your trading. In fact, this would be a good spot to help us in terms of what we focus on in the webinar. Just type into the Q&A box what you think you could be doing better, where your trading breaks down. What is missing in your trading? Is it knowing when to take profits? Is it knowing when to cut losses, when to pull the trigger on a trade? Just give us a sense of what your pain points are, because if we can help you solve those, then I'll feel good about the webinar. And I see that as with many of our webinars, a lot of you are concerned about the market. I didn't even mention that, but there's a lot of concern about whether the market is peaking. I think today will go a long way to dissolving those fears. And then many of you are concerned with how to sell and when to sell. And we'll talk about that in the webinar. So I'd like to start out by showing you how you can make money in 2017. You have to have a trading plan. For most people, that's what's missing in their trading. And if you didn't type that into the question box, think about whether you really do have a trading plan. It's important to have a sense of the market direction, and we're going to start out by looking at that because we've gotten a lot of good feedback on webinars now that we've added a little bit of market direction at the beginning. Trend of corporate earnings is very important. We've just witnessed the power of positive earnings reports with a big boost for the market from Caterpillar and McDonald's today, and then after the close, Wynn and Chipotle, big stocks formerly bearish, reporting very positive earnings, along with a lot of companies that are bullish in the Chaikin methodology, reporting positive earnings surprises, and that all leads to stock selection. Ultimately, it's a stock picker's market, and we're going to show you how to do that and do it well, because the most likely scenario for 2017 is higher interest rates and rising earnings, and that's a bullish scenario. But in periods of rising interest rates, stock selection becomes very, very important. Now let's take a look at the S&P 500 index by looking at the SPDR ETF. It's the most actively traded instrument in the US markets. And we had been in a very well-defined uptrend channel until we broke out post-election. And that was accompanied by strong Chaikin Money Flow. Now, I know a lot of you are familiar with Chaikin Money Flow through your online brokerage platforms. If you're a professional on the webinar, it's on Bloomberg and Reuters, stockcharts.com. It's all available for free right there. And Chaikin Money Flow has been around for 35 years. We introduced it in 1982. We started teaching institutional investors how they could utilize Chaikin Money Flow to monitor the tracks of their competitors, in essence, following the big money. So as we rallied from the February bottom in 2016 and then the Brexit low here in June, institutional investors came into the market. The way we know that is that Chaikin Money Flow was green or strong. And so we broke out with very strong money flow. And then we've been in an 8-week consolidation. Now, consolidations are pretty interesting because people get antsy and the talking heads on CNBC start coming out in droves, trying to be a hero calling a market top. So think back to what we've just been through. We had 8 weeks of selling prior to the presidential election, and it didn't really break the downtrend. And then we took off after the surprising Donald Trump victory. Heading into the French presidential election, let's actually go back a week before that. The Friday before Easter, which was a holiday, was preceded by a down day because of nervousness about what was going on in North Korea and Syria. And then the market rallied. Then we came back down again last Friday ahead of the French elections. So if you watch CNBC, you saw and heard a lot of bearish commentary. And that the bottom line is we're in earnings season and earnings drive the market. These are just headline grabbing comments and bearish headlines that sell newspapers and increase viewership. But at the end of the day, earnings drive the market. So look what's happened here in the last 2 days as we've had a spate of positive earnings reports on top of the French election coming out in a reasonably benign way with one very conservative right-wing candidate and one middle-of-the-road candidate, which was, in theory, Wall Street's hope and best option. We've broken out. Not only have we broken out from this flag pattern, but we've broken above that uptrend line again, and we're in a position to attack 2,400. No guarantees that we go through it, but we've been saying buy on weakness. We're going to show you how to do that with very specific methodology. The bottom line on this chart is the market consolidates periodically. We can see 3 consolidations on this chart for the election, December, January, and now for the last 8 weeks since the March 1st peak. We're in a bull market. Now, a lot of people are nervous because from the February 16th bottom to the top on March 1st of 17, the S&P 500 index had rallied 25%, causing a lot of analysts to talk about overvaluations and a potential correction in a bear market to follow. Well, the reality is quite different. This chart from Citicorp Research shows you that in the 72 previous rallies of 25% or more, going back to 1945, 50% of the time you go up another 25% in the ensuing 12 months. Another 25% of the time you continue higher, but at a much more modest pace, an average of 5%. I suspect that's the market climate we're in today. So from the 2,400 high, another 5 to 10% puts you right at our long-standing target of 2,450, 2,500 on the S&P. Maybe we go a little higher. Only 25% of the time are stocks lower 12 months later after rallying 25%. So where are the odds? The odds favor buying dips, and corrections come all the time. The irony is we usually get one correction a year on average of 5 to 10%. We haven't had a correction like that since February of 2016. That's caused a lot of market analysts to say, well, we're overdue. Well, we're overdue for a lot of things, but there's no predicting when that correction is going to come. Most likely to come when everybody's bullish, not when the market's down for 8 weeks. Now, if we haven't convinced you that being bullish is the right posture here, this is a way to hedge a May decline. Earnings season carries into early May. Some people think the market sells off after the first quarter earnings reports come out. They're so strong this year that we'll have to wait and see. But if you're bearish, if you've got a portfolio of $100,000, you can hedge that. And we're using ideas from our options play module that we've bundled into Chaikin Analytics, which is a probabilities-based options idea generation capability. And a vertical put spread, for those of you who are familiar with options, is a very cost-effective way to hedge your portfolio. So for $151, you can hedge $24,000 worth of the S&P 500. Multiply that by 4, it means for $600, you can protect yourself against a 4% decline in the S&P through June 2nd, roughly 6 weeks from now. If you're a speculator and you sell the 238.5 put and buy the 238.5 put and sell the 232 put expiring on January 2nd, you've got over 300% profit potential. So you can hedge if you're bearish or concerned about the market and then hold on to your portfolio, or if you really want to take a stand here, and we're not suggesting you do because we've been bullish so far in this presentation, you can put on this put spread betting that the market's going to go down between now and June 2nd. Now, one thing we like to key in on in this webinar is how important it is to focus, because we're in the age of distraction. Our biggest enemy is information overload. In our personal lives with Snapchat, Twitter, Facebook, email, LinkedIn, and in the investment decisions that we need to make, there is just so much information to process. So at the center of this slide is the key question: how do you focus in the age of distraction? Now, the Chaikin Power Gauge rating cuts through the clutter. We're going to get into the Chaikin Power Gauge rating, what's in it, why it works, in a few minutes, but first we're going to give you some very concrete examples. So on the right is what fundamental data looks like. And I strongly believe, as I said in the beginning of the webinar, that to make money, whether you're a trader or an investor using options or stock, you must know the fundamentals of the stocks you're trading, and then overlay some technicals to help with your timing. So the power gauge rating, which is output as a gauge here on the left, and we're using Llama Research as of March 27th when it was under 128, and that's going to be one of our core examples in the webinar, helps cut through the clutter. It condenses all of that fundamental data into a gauge and then enables you to see what's driving the rating. And the Chaikin Power Gauge rating is the centerpiece of our platform called Chaikin Analytics. Everything we do, from our low-end products to our high-end products, everything that informs my decision-making in my weekly market letter is based on the Chaikin Power Gauge rating. It's our solution to the information overload problem. Now, zeroing in on what it takes to trade successfully during earnings season and beyond is pretty easy. Traders need an edge. Successful institutional investors, successful hedge fund traders have an edge. And the edge that we bring to you is what we call the Chaikin Directional Edge. We accomplish this by combining fundamentals with technicals into a quantitative model. And then we give you 6 pairs of buy and sell signals for better entries and exits. Now, the Chaikin methodology, which is built around the power gauge rating, is condensed into this pyramid. At the top of the pyramid, the power gauge rating, the fundamental potential of a stock to outperform or underperform the market. At the bottom of the pyramid, 2 only technical indicators: Chaikin Money Flow, which, as I mentioned, we know many of you are familiar with, and Chaikin Relative Strength. Very, very critical to know whether a stock is outperforming or underperforming the market, because that tends to persist, as you'll see in a moment, for extended periods of time. And then right in the middle, those buy-sell signals, so important. This is a disciplined methodology for investors and traders, and it leads to success because it combines the key elements that you need to make profitable decisions. So I'd like to start the webinar with some very concrete examples before we even delve into the power gauge rating. We have 2 patterns that we've identified that really highlight this discipline methodology. The first one we call the classic Chaikin bull. The power gauge rating is bullish, meaning that the fundamentals are favorable for that company. The stock is outperforming the market, so you know that the market agrees with you. And then finally, Chaikin Money Flow is strong, indicating that institutions are buying the stock and not selling it. And we'll see examples of both of that in a few minutes. So here's an example of a classic Chaikin bull. It's AMAT in the semiconductor industry. And at the bottom of this one-year chart from Chaikin Analytics is what we call our power gauge ribbon. Normally goes from red to yellow to green, depending on whether the power gauge is bearish, neutral, or bullish. In this case, AMAT has had a bullish rating on this one-year chart almost exclusively. And you could go back another 3 months, 15 months of a bullish fundamental rating. Right on top of that is Chaikin relative strength. Now you could get relative strength ratings in a lot of places. For instance, Investors Business Daily outputs relative strength as a number from 1 to 99. In fact, they've had a system for 25 years that they call their 90-90 system. They have a fundamental rating, and then they have a relative strength rating. We've gone one step better. We've converted all this to pictures that are easy to understand because numbers contribute to information overload. Now, above our overbought, oversold indicator is Chaikin Money Flow, and when you see big mountains of green like that, it's telling you institutional investors are accumulating the stock. And then those green triangles are one of our 6 buy signals called an oversold buy. Let me explain that to you right up front. This is a signal that's triggered when a stock makes a new 8-day low and gets oversold and has a bullish Chaikin power gauge rating. So there's your directional edge. The power gauge, when it's green or bullish, is telling you that the likely direction for this stock is up. One other thing we do, which is very relevant during earnings season, is we color code the last 4 earnings reports, and this EPS icon, either red, gray, or green, depending on whether the stock outperformed or underperformed Wall Street estimates. It's what's known as a positive or negative earnings surprise. Now, right at the top of the chart, we tell you the next earnings date, which in the case of AMAT is May 18th. You can see that the last 4 earnings reports have all been positive earnings surprises. And then finally, we have an earnings alert indicator, which summarizes the potential of a stock to report a positive earnings surprise in the next report. In this case, it's a green exclamation point that's telling you expect a positive earnings surprise again. And look what happens. When they do report a positive earnings surprise, the stock keeps going higher. That's why we call this a classic Chaikin bull. This is the perfect example of a methodology and a set of indicators that can point your trades in the right direction. Now, classic Chaikin bear, just the opposite. Power gauge rating is bearish. Stock is underperforming the market. And Chaikin Money Flow is red, not green, indicating that institutions are selling the stock. So here's our poster child, Under Armour. Big institutional favorite when it was trading in the mid-40s. Power gauge rating didn't like the financial metrics. Valuations were very, very high. It's been bearish off and on all through 2016 and 17. And look at the relative strength, underperforming the market. So the market is agreeing with the model. Then when you look at Chaikin Money Flow, what do you think the institutions have been doing in this stock? Well, so self-evident, I labeled it here. Institutions have been selling the stock every chance they get. Ahead of the previous earnings report, and actually ahead of the one back in October, which isn't on the chart because the company recapitalized and changed the symbol, we had sell signals ahead of both those earnings reports. Now, Under Armour reports this Thursday, April 27th. Our earnings surprise indicator is saying there's going to be another negative earnings surprise. So even though the stock is down from 45 to 20, If they do report another negative earnings surprise, there may be a profitable put trade. The beauty of that is that if you buy a cheap put and they do report a negative earnings surprise, you'll benefit in a big way. If they report a positive earnings surprise, which is always possible after 4 quarters in a row of negative earnings surprises, your risk is limited to the cost of the put. So we're jumping ahead a little, but I want to pull it all together with you before we look at the power gauge rating, which is where we are right now in the webinar. So the power gauge rating is output as a gauge. We started out with an iPhone app. So we needed a display that was very simple to understand, that could be readily put on a mobile device like an iPhone. So it's a very simple rating, but don't confuse simple with simplistic, because under the hood, there's a lot going on. There's a lot of number crunching going on. We'll see that in a minute when we look at the 20 factors. And I like to say on these webinars that the power gauge rating is like a Ferrari engine in a Chevrolet body. And it can be your GPS during earnings season. That's why I like the car analogy. And that's really critical. As we get into our earnings season methodology and examples, you'll see how the power gauge rating helps during earnings season. Now, about a year ago, we formed a partnership with John Carter of Simpler Trading. He's presented to our Chaikin community, and we've presented to the Carter community, Simpler Trading. John is one of the best pure traders I've ever met. And he looked at the Chaikin power gauge rating. He was introduced by mutual friends and got pretty excited about it. He called it an objective awesome meter for stocks, saying there's a lot of hyped up tools out there, but when I find something interesting, I'll let you know about it. So you can imagine that a single tool that combines 20 plus technical and fundamental factors to anticipate a stock's potential for profit got my attention. He called it an awesome meter for stocks, and the key is objective. So what were those 20 factors that got John Carter so excited? Well, here they are. This is the result of a 1-year research project that was put to bed in September of 2010, and it reflects everything I learned in 45 years at that point on Wall Street. These 20 factors, which I distilled down from 200 in a 1-year research project, are what institutional investors look at every day when they make investment decisions. Now, the stock market is comprised of various constituencies. You've got value investors, earnings momentum investors, dividend investors, and they have differing time frameworks. Got day traders, swing traders, intermediate term investors, long term. So there are a lot of different styles and time horizons that go into making up stock market movements. This model is an eclectic model which reflects all of those various constituencies. That's why it's worked so well since we first made it available to the public in January of 2011. The model's never been changed. The weights have never been changed. So for instance, financial metrics are actually 35% of the model. The model itself is 85% fundamental and only 15% technical, but it includes those key technical indicators like relative strength and Chaikin Money Flow that we looked at on the chart. But what I'd like to zero in on for today's webinar is one of the earnings factors. It's known as earnings surprise, and one of my mentors, George Douglas at Drexel Burnham in the mid-'80s, did the seminal research on earnings surprise and earnings estimate revisions. And George taught me 2 things when he gave me access to Drexel's quantitative database, which was one of only 2 on Wall Street at the time. Morgan Stanley had the other. He said, Mark, earnings surprises come in bunches. There's never just one of them. And the second thing he taught me was that when a company reports a positive earnings surprise, Wall Street analysts take notice and tend to change their earnings estimates. You get a positive earnings surprise, Wall Street analysts will raise their estimates. Get a negative earnings surprise, they tend to lower their estimates. Now, the reason that's important is that Wall Street analysts at firms like Goldman Sachs and UBS and Morgan Stanley still have a lot of clout with institutional investors. So when the analysts change their estimates, the salesmen at these firms are on the phone almost immediately with their institutional clients, telling them the news, hoping to get an order, and that's really the way Wall Street works. Academic research has shown that analyst estimate revisions are the single biggest short-term driver of stock price movements. And that's why there's so much money to be made during earnings season. If you can be ahead of the crowd and know with some degree of probability that a stock is likely to report a positive or a negative earnings surprise. So this model is so powerful because the financial metrics are the bedrock of the model. They don't change very often. They're the value metrics that a Warren Buffett would look at. Earnings are what Jim Cramer might look at. And then this pattern of earnings surprises leading to earnings estimate revisions is what creates profitable opportunities during earnings season. So a little bit of performance history. In 2016, using the Russell 3000 universe, the very bullish stocks, 428 of them at any given point in time, were up 32%. Now, how many of you would have been pleased if your account was up 32% in 2016? Well, if you follow the power gauge rating, you're more likely to achieve that kind of return than if you're buying stocks with a very bearish rating, which were up only 9.5%. It was a bull market year. The average stock in the Russell was up 24%. Let's go back to 2015 because the picture was completely different. In 2015, you actually had a bear market in energy stocks and small cap stocks. So the very bearish stocks in the Russell 3000 were down an average of 17% in 2015. Very bullish stocks were basically flat. And it was a flat year in the S&P 500 as well, except for Amazon, Facebook, Netflix, and Google, those infamous FANG stocks that Jim Cramer and my friend Bob Lang coined. So if you can avoid the very bearish stocks on the long side and focus on the very bullish stocks, you should be able to make money in all kinds of markets. And of course, if you turn it on its head and use the very bearish stocks for put buying opportunities, then you can make money on the downside in bull and bear markets. Now, one final piece of validation. We have two partnerships ongoing with a third one already announced. With First Trust Portfolios, in December of 2015, we helped create 20 stock portfolios, low volatility, high growth potential, and First Trust started marketing unit investment trusts. There have been 6 of these. The 7th one is due to be launched in mid-May. There's over $60 million being managed based on a methodology that zeroes in on the same stocks that you'll find on the long side using the Chaikin power gauge rating. With NASDAQ, we created 3 NASDAQ Chaikin indices based on their large cap, small cap, and dividend achiever indexes. The goal was to have ETF creators, exchange traded fund creators, license these indices once they had proven themselves with a 3-year track record. We launched the indices on April of 2014. They get changed only once a year, so they're buy and hold portfolios. They're a subset of the underlying NASDAQ indexes. And they've had a great 3-year track record. So good, in fact, that the largest mutual life insurance company in America, New York Life, and their investment management subsidiary, Mainstay, have licensed all 3 of these indexes. They filed registration statement with the SEC. This is public knowledge. That's all I can say about it. And the first exchange-traded fund based on the Chaikin methodology, the IQ Chaikin Small Cap ETF, will be launched in mid-May. And you can go to ETF.com to see the press release, but we're in a quiet period, so I can't say any more about that. The reason this is important, not tooting our horn or looking for you to buy the ETF, is because the power gauge rating has proven itself. It's proven itself to First Trust, the largest creator of exchange-traded funds, proven itself to NASDAQ. They require no further explanation, and proven itself to the largest mutual insurance company in America, who manages over $600 billion in their investment subsidiary. So if these people believe in the power gauge rating, I want you to come away from this webinar believing in it as well. So we've already seen the classic Chaikin bull, which combines fundamentals with technicals by looking at the power gauge rating and Chaikin relative strength. We call that the dynamic duo. It's a very powerful winning combination that helps you find big winners and big losers. And we also think that the key to making and keeping profits and staying on top of the market is spotting what we call personality changes. A personality change is defined as a stock that's been outperforming the market, so the relative strength indicator is green, that begins to underperform the market. So the relative strength indicator turns red, and the persistency is built into the way we created the indicator so that these don't whip around. You can depend on relative strength persisting over extended periods of time. It validates the research that I initially did in 1967 on the relative strength concept of investing. First technical indicator I ever looked at. Now, here's an example of a stock that underwent a bullish personality change. Now, the reason this is important is that too many people on Wall Street, both traders and investors, individuals and professionals, get stubborn and either fall in love with a stock or fall out of love with it. And I call this putting your feet in cement. It's a sure road to ruin in the stock market. You've got to be flexible and let the market dictate. So in this case, Anthem Health, which had been underperforming the market for 6 months in the medical care group, people concerned about the election. Ironically, they were concerned that Hillary Clinton would come in and put pressure on the healthcare system. Donald Trump has come in and he's trying to put some pressure on the healthcare system. But in spite of that, with a bullish power gauge rating, Anthem Health had a bullish personality change. How do we know that? Well, look at the yellow zigzag. You don't have to memorize numbers, you just have to look at the chart. Relative strength went from underperforming to outperforming, and that's when we have a bullish personality change. And you're rewarded when you spot that. Now look at the Chaikin Money Flow that accompanied the bullish personality change. The institutions reversed on a dime and started buying healthcare stocks like Anthem after the Trump victory in November. The stock was trading at about 126 when all this took place with a bullish power gauge rating. And it's gone all the way up to 170, making another new high today at 172.61, up 2.5%. Along the way, we had some buy signals. This signal is called a relative strength buy. Now, for those of you who are traders, I'll point out 2 things. A, all of these signals are on our website. So go to checkinanalytics.com, whether you're a visitor or a subscriber. The underlying methodology behind these signals is described there. But it's important to note that every signal has a different time frame, that none of them work all the time. In the case of the relative strength signal, works about 70% of the time, but the beauty of this for swing traders or options traders is that these relative strength signals persist for 4 to 8 weeks. That oversold buy signal that we looked at and the money flow buy that we'll look at on a couple of other charts have a shorter lifespan. They tend to work for 1 to 2 weeks, 5 to 10 trading sessions. So a lot of options traders like them, and some swing traders will use them to get into a position. But when the relative strength signal triggers, as you can see on the chart, you can ride out some market cycles and maximize your profits, particularly if you're in the options trading game. Now here's an example, Tractor Supply. They provide farm equipment and supplies for farmers. Bearish personality change back in late June, at a time when the power gauge was bearish. So what did you have? You had the fundamental potential for the stock based on those 20 factors bearish, and the stock went from outperforming to underperforming the market. If you own this stock in a long portfolio, in your IRA, your 401k plan, or you're trading it from the long side, this is when it becomes critical to know that something has changed. The stock was trading at about $90 on its way to below 65. And if you can avoid stocks like this and then look for put buying opportunities, and here we have our money flow sell signals. Remember I said time duration is 5 to 10 days, and they tend to work about 2 out of 3 times. So not everyone's a winner, although on this well-chosen chart, these are all profitable trading signals. And then you see the Chaikin Money Flow indicating that institutions keep selling the stock any chance they can get. And the reason we know that is there's no green here from December through May, late April in this case. Now, Tractor Supply reports earnings after the close on Wednesday, tomorrow after the close, with the expectation of a negative earnings surprise. Anthem, on the other hand, reports before the opening tomorrow, and we don't have a positive earnings surprise indicator, so we'll have to see what that is. And with the stock making new highs here, they better report good numbers, otherwise Wall Street is going to punish them and profit takers will come in. But here are 2 stocks that report this week, each illustrating a bullish or a bearish personality change. Now, going back in time illustrates how important it is to know, particularly when a bearish personality change has taken place. There are a lot of opportunities on the upside, but if you get stuck in a stock that's had a bearish personality change, as SunEdison did way back in July of 2015, that can be very painful, cost you a lot of money. So what happened to SunEdison, which was a darling of the solar energy business? Well, as it was making new highs, institutions were already selling it, new highs above 30. Hedge funds had big positions in it. Merrill Lynch was recommending it up there at 28.30. But money flow was coming out of it. What were institutions doing? They were selling the stock. The power gauge turned bearish in mid-July. The stock was around 27, didn't like the debt that they were taking on. The value metrics were very stretched. The company was not making any money, so the earnings components were not good. And then you had a bearish personality change. So there was your dynamic duo on the downside, ample opportunity to get out of the stock. And even after it had dropped from 30 all the way down to 8 and rallied back to 10, you had sell signals, which gave you the opportunity to go short or buy put options. And if you look at the bottom right, you'll see that this chart ends in April of 2016. The reason is the company filed for bankruptcy. And we captured this shot on CNBC of Jim Cramer et al. Talking about this. Now, Merrill Lynch actually did put out a sell recommendation on the stock back here in February at $3, down from 30. So using this methodology, you can be smarter than the big Wall Street analysts and be ahead of the curve. We exhibited at an options industry council show last May in California, and I was using SunEdison in a demo to illustrate why the power gauge was so important. And a broker from Merrill Lynch walked by and said, wait a minute, could you go back to that chart? And here was his comment. If I only had Chaikin, because he said, I bought SunEdison on the way down at 15 from 30 because my firm Merrill Lynch was still recommending the stock. If I'd been using Chaikin, I could have saved my clients a lot of pain and money. And that's what this is all about. Avoiding the losers is as critical as finding the winners. Now, I mentioned in that pyramid that we have 6 pairs of buy and sell signals. We've seen 3 of them. Money flow, buy, oversold, buy, and sells are filtered by the power gauge rating. There's your directional edge. Relative strength signals don't care about the power gauge rating, but they do care about whether the stock is outperforming or underperforming, another directional edge. Now, if you combine the Chaikin buy and sell signals with the 3 key indicators, the power gauge rating, relative strength, and money flow, you have what Warren Buffett calls the ideal setup. Warren Buffett has famously said that they don't call balls and strikes on Wall Street, so you don't have to swing at every pitch. You can wait for your pitch. Now, it's an interesting anecdote that Warren Buffett's hero in life has nothing to do with the stock market. It's Ted Williams, arguably the best hitter ever in baseball, the last hitter to bat over 400. And the reason Warren Buffett loved Ted Williams when he was alive is that Ted Williams only swung at a pitch that he knew he could drive. He had a sweet spot. And Warren Buffett has basically encapsulated that in his concept of waiting for your pitch. So here's an example of the fat pitch, the perfect setup. Llama Research. We're going to get back to that when we look at earnings season. But you've got your classic Chaikin bull. The power gauge has been bullish for almost a year. The relative strength has been green, so it's outperforming the market. And look at the money flow. Very positive. Along the way, you've got the buy signals. And the last oversold buy signal, that 8-day low, and by the way, I owe that technique to my long distance mentor, Larry Williams, who's done some incredible technical research and pattern recognition research. That last buy signal came just 2 days ahead of earnings. Now, if we showed you a 5-year chart, which is very easy to access on Chaikin Analytics, you'd see that there have been 16 straight quarters of positive earnings surprises leading up to this April quarter. Now, my wife Sandy, who's involved with marketing and PR for Chaikin Analytics, mastered this very disciplined, simple 3-step approach that we've been talking about 3.5 years ago, never having bought a stock in her life, not overthinking it, keeping it simple. And she's been outperforming the market and generating consistent profits for 3.5 years. Guess what? Sandy bought Llama Research 2 days ahead of the earnings report, maybe the day before, based on this perfect setup. And she got out yesterday with the stock above 140, making over 14 points in the stock, better than a 10% return in just 3 days. And you can do it too. If Sandy can do it, you can do it. That's what this webinar is all about. She beats the pros. In fact, John Najarian jokingly said when Sandy gave a webinar, first of all, they said, we want Sandy to present. You've done it too much, Mark. When he heard Sandy's presentation, he came over to her and thanked her and put his arm around her. We have a photo of that and said, you can manage my money anytime. And it's that simple. If you don't overcomplicate, if you don't overthink it, if you don't bring preconceived notions, but you let the market and the indicators guide your decisions, you can make consistent profits. Now, before we get to earnings season, I want to go into one more concept, and it embodies the secret trade that 95% of traders never see. We call it a bearish money flow sell alert, and it's part of a pattern that we call stealth accumulation and stealth distribution. We've been teaching this to institutional investors for over 35 years since Chaikin Money Flow became available. Now we're going to use Qualcomm as an example. This chart ends in December of 2016, when I gave a webinar back in November, and then again in December, we used Qualcomm as an example. Here's what we call stealth accumulation. Even when the stock was selling off for 4 or 5 weeks, 5 to 10%, look at the money flow, it stayed green. So you were encouraged to buy this anytime you could with the power gauge bullish and relative strength positive. And then Qualcomm spiked up on some news to the upper volatility band, made a new 52-week high, and look at the money flow. Red, not green. We call that a bearish money flow sell alert. So you could have taken your profits on that spike, knowing that the institutions were actually selling the stock, the public was buying it. And then on the way down, you could have gotten out anywhere from 66 to 70. Now let's see what happened subsequent to that webinar where we highlighted Qualcomm. It dropped from the 67 area all the way down to 52, and it's gone nowhere ever since. Ultimately, you had a bearish personality change, power gauge turned neutral. You had a relative strength breakdown, which triggered the bearish personality change. So if you had followed this buy signal, you would have gotten out at that point. Follow the discipline. Don't second guess these indicators, and they'll work for you time and time again. Now, here's an example of stealth accumulation just recently in a company called Essent, which is in the mortgage insurance business. It sold down to the lower volatility band, the opposite of what Qualcomm did, and look at the money flow. Stayed green. We call that stealth accumulation. So you can buy the stock there, knowing that the institutions are not contributing to the selling, they're actually taking advantage of it. So now let's get into the heart of earnings season. Now that you've seen the basics, I'm going to show you how to make money during earnings season consistently and with limited risk. Now, earnings season happens 4 times a year because most companies are on a calendar year. And they report first quarter earnings, which begin on January 1st and end on March 31st, the quarter itself, beginning in April. So January, April, July, and October, you have a 6-week period with a big spate of earnings reports. As I mentioned in the beginning of the webinar, this week is the busiest week during earnings season. Now, a lot of people are reluctant to trade during earnings season. If you're one of them, raise your hand in the chat box. Let us know whether earnings season spooks you. And if it does, there's a good reason for it, because there's an awful lot of speculation in the media around companies' earnings reports. Will they beat? Will they miss? Will they disappoint? It creates volatility. So you need an edge. And the Chaikin Power Gauge rating gives you that directional edge. Stocks with a bearish power gauge rating are twice as likely to report a negative earnings surprise. Stocks with a bullish power gauge rating are more than twice as likely to report a positive earnings surprise. So here is an example, TripAdvisor, of a stock with a bearish power gauge rating, underperforming the market, where the institutions were selling the stock, and a history of negative earnings surprises. And we had sell signals, in this case are overbought sells, well ahead of these last 2 earnings reports, really the last 3. And in each of those earnings reports, the stock dropped between 10 and 30% after reporting a negative earnings surprise. So one of the ways that you make money during earnings season is to use put options to have a limited risk way, because the cost of the put is your risk, to benefit from a negative earnings surprise in stocks with bearish power gauge ratings that have a history of earnings surprises. Remember, I shared with you what my mentor George Douglas told me in 1983. Mark, earnings surprises come in bunches. Here's an example of that. Second example is Under Armour. We've already looked at it as a classic Chaikin bear. They report earnings Thursday after the close. We're not sure whether it's after or before, but they are reporting on Thursday. And there may be another opportunity, particularly if the stock rallies into that earnings report. Very often, a stock with a bearish rating will rally into the earnings report. We're going to see an example of that in a minute. So those are two examples of how you can make money anticipating positive or negative earnings surprises. Now, it's important to have a way to monitor upcoming earnings reports and also know whether a company is likely to report a positive or negative earnings surprise. In Chaikin Analytics, in the weekly market letter that I write, I've got a little segment called Upcoming Earnings Reports. And here are two snippets from this week's market insights, which come out on Sunday, and the previous week's. So on April 17th, we knew that Llama Research was going to report on Tuesday and that W. Granger was going to report on Tuesday, one with a bullish, one with a bearish rating. And then Schlumberger was due to report on Friday, 21st. This week, we knew that a whole slew of stocks were due to report. And I zeroed in on Tractor Supply, which you already saw, and Orly, and we'll show you an example of that in a minute. So here's our way of helping our subscribers monitor upcoming earnings reports. You can go on the internet to Morningstar or Zacks and see which companies are going to report, but without that key piece of information, the power gauge rating, your directional edge, just knowing that a company is going to report, in my view, is not good enough. So you have to have some other way to determine which side of the fence you want to be on and whether you want to be trading that earnings report. So here's Llama Research again. We looked at it before. You knew it was going to report on Tuesday, so on Monday you're looking to buy call options, or in Sandy's case, she doesn't trade options. She just bought the stock for 127 and sold it at 141. But you're prepared, you've got a plan, you know what you're looking for, the perfect setup, and then the event, the earnings report. Granger, on the other hand, 2 weeks ago, negative earnings surprise. Last week, however, sell signal preceding that, negative earnings surprise. The stock dropped from 222 all the way down to 190. Big opportunities to make money with puts in a stock like that. And then Schlumberger is an interesting case because the energy sector has been very weak. We did a webinar on April 11th where that yellow arrow is. And we used Schlumberger as an example of a stock that had just triggered a sell signal, in this case, our relative strength sells. So we expect the stock to be weak for 4 to 8 weeks. Bearish power gauge rating, underperforming the market, institutional selling, and an earnings report coming out on Friday, April 21st. So you see what happened after the negative earnings surprise. The stock dropped from 77 all the way down to 73. And on an up day in the market here today, the stock was down. So on February 11th, we suggested using our options play ideas module that if you were bearish on Schlumberger and wanted to take advantage of a potential negative earnings surprise, you could do a bearish vertical put spread. For a cost of $172, you could be short $8,000 worth of Schlumberger. Excuse me one second. And look how that trade has worked out in 2 weeks. Remember, they reported on the 21st. On that webinar on the 11th, we showed this bearish put spread as a potential way to benefit from a bearish earnings surprise. You got the bearish earnings surprise. The put spread went from $1.72 to $4.50, 160% gain in 2 weeks. There's a little more potential in that trade, but why be greedy? Take it off the table with the market so strong, and book the profit. Now, O'Reilly, as we mentioned, reports earnings after the close tomorrow. How do we know that? It's right here at the top of the chart. And we were looking for a rally to put on a bearish position in O'Reilly, and we got it because Barron's recommended O'Reilly this weekend, and the stock spiked up dramatically, capping a 5-day rally in all the auto parts stocks. Perfect opportunity to buy put options. We actually said that these stocks should be sold on any additional strength. Sunday, you got it on Monday. And then this morning, Deutsche Bank downgraded O'Reilly ahead of the earnings report that's due out tomorrow. That's very unusual. It's a big statement by a Wall Street firm cutting their rating on a stock ahead of an earnings report. They're obviously anticipating a negative earnings surprise and wanted to get ahead of that. So if you wanted to trade O'Reilly, this bearish vertical put spread again crops up as the highest probability idea on the short side in O'Reilly. The way we know that is Options Play, this independent options module that we license and put into Chaikin Analytics, has a big green circle around the score of 133 with a check mark. So here's a stock that's $263, 100 shares, 26,000. Very few people want to go short a $260 stock. But for $1,000 today, you could have bought a put spread with 30 points of potential, the ability to make almost 200% on your money if O'Reilly reports a negative earnings surprise and trades down to 240, and you've got till June 16th for that trade to play out. Now, the recent low in O'Reilly is 250, but if they make an announcement with a bearish earnings surprise, it's not unlikely that they would break 250 again. Not a recommendation, just an example of a very disciplined methodology leading you to a low risk trade, a defined risk trade, $1,000 per 100 shares, because the price of the put is your total risk in the trade and the ability to make $2,000 if the trade works. Now, I want to show you our newest piece of intellectual property, a way to generate profitable stock ideas that we call our stock discovery engine. And it puts you in the driver's seat because you can seed the discovery engine with any stock that you're following, whether you like it or loathe it. In this case, in a webinar that I did on March 28th, I took Under Armour, our classic bear, and I put it into the stock discovery engine, and I got back 2 sets of ideas. I got potential swaps in case I wanted to swap out of Under Armour. It was suggesting Skechers in the apparel group. Then I also got other apparel stocks with similar characteristics to Under Armour. The stock discovery engine works in the same way that Spotify helps find you music, or Netflix helps find you movies that you like, or Amazon recommends books or merchandise based on your past interest. You put in a stock, and I was particularly interested in Lululemon, another mid-cap apparel stock, the bearish earnings estimate trend, because I knew the power gauge rating had been bearish on Lululemon for almost 2 years. And Lululemon was due to report earnings just a day after the webinar. So we mentioned on the webinar that a put purchase in Lululemon, which rallied 3 points into the earnings report that came out after the close that day, was a high probability trade. And sure enough, you got a negative earnings surprise, and Lululemon dropped 23% the next day. Gap down on heavy volume, and there was your profit. The stock's basically gone nowhere ever since, but when you get a gift like that, take it. take your money off the table, say thank you, and benefit from this disciplined methodology. Now, I'd like to end the webinar by showing you how I put my plan into action every week when I write my weekly market letter. It's what a trader should do every week heading into the trading week. First, I screen for stocks. In this case, we're going to focus on the long side because we're bullish on the market. So I screen for strong stocks in strong industry groups. I then loop through all those charts. It takes me less than a minute or two using Chaikin Analytics. I then seed the discovery engine with a stock that I've zeroed in on. Decide on a buy strategy. How am I going to enter that trade? And then I check to see if there are any options plays that make sense. So here's an example of that, but without all these tools that we've introduced over the last 2 years. I'm going back in time to a weekly market letter that I wrote in July of 2015. Now, we didn't have the screener, the discovery engine, the earnings alerts, options play integration. So I basically used the charts in Chaikin Analytics and some hand-to-hand combat going through charts, looking for ideas. And I found Yelp, which I made my bearish stock of the week. They were due to report earnings 2 days later. They had had a first quarter earnings report that was very disappointing. And remember, earnings surprises come in bunches, and the stock dropped 20%. So I said, buy put options on Yelp ahead of Tuesday's earnings. This actually comes from a webinar that I did in July of 2015. Here's what happened to the stock. Negative earnings surprise. This is where we suggested that a put strategy in our weekly market letter was a good strategy. Stock reported a negative earnings surprise, dropped from 33 all the way down to 24 and continued lower. And we got this wonderful testimonial from Mike T, netted $17,408 in profits this morning. I found more success in the past 2 weeks using Chaikin than I had the rest of the year. I had the biggest winner of the year today on Yelp earnings based on the bearish play of the week. Risked 7,000, netted 17,000. Now let's fast forward 2 years and show you how easy we've made it for you to find these trades yourself. So I screened this screen is from a week and a half ago, before I wrote the market letter. I screened for stocks in strong industry groups with a bullish power gauge rating, where the other two components of the classic bull were in place, strong money flow and relative strength. And then to narrow the field down, I only wanted to look at stocks that were oversold. And I immediately zeroed in on Llama Research, which was 125 on its way to 145 today, and a company I had never heard of called Accumulation. Now I looped through all these charts in less than 2 minutes, looking at the power gauge, the relative strength, and the technical pattern. And Accumulation caught my eye because it's a technology stock, but it's small cap. And I felt that small cap technology stocks were ripe for purchase. So I seeded the discovery engine on April 16th, the day I was writing my market letter, with Accumulation, and I got back 5 stocks with very similar characteristics to Accumulation. I looped through those 5 in Chaikin Analytics in about 15 seconds and zeroed in on Integris, which is also a technology stock, small cap, strong earnings, and had a buy signal. And I made those 2 stocks my bullish stock of the week in market insights that came out on Sunday, April 16th. I said both of these stocks meet the criteria for a classic Chaikin bullish buy and are attractive for speculative accounts at current levels. So this was a full out, unhedged buy recommendation on these 2 stocks. And let's see what happened to them. Accumulation went from 1805 to 1905 today, so up over 5%. And Integris went from 2255 to 2410, up over 7%. This is the kind of plan that you need to successfully trade in and out of earnings season. It works. I use it every week to write my weekly market letter. We're out on a limb every week with a stock to buy or sell. My wife Sandy follows the same methodology to trade, and you can do it as well. Now, Chaikin Analytics comes with our new discovery engine, options play, and earnings alerts you've seen, our screener, news, and intraday charts. Before most of these new pieces of functionality were in there, we got a really wonderful review and technical analysis of stocks and commodities. By the way, the teaching part of the webinar is over. I'm sure you realize that this is the sales pitch, but one that I really feel very strongly about. Barbara Starr, who I've known for about 30 years, is a pretty tough cookie. She's seen everything in technical analysis, and in August of 16, she said, Chaikin Analytics provides a fast and reliable method for identifying stocks. With the inclusion of a seamless options feature and a stock screener, they've added significantly to the range and flexibility of services. Subsequent to that review, we added intraday charts, earnings alerts, news, and our stock discovery engine, further enhancing the product. So we'd like you to share in the power of Chaikin Analytics and join the Chaikin community. Chaikin Analytics is normally $1,950 a year for an annual subscription. As a webinar special, we'd like to reduce the price to $1,750. So when you go to chaikinanalytics.com/earnings, you'll see our fulfillment page. This offer expires Friday, April 28th, or you can email sales@chaikinanalytics.com or call 877-697-6783 if you have any questions. Now, we got this testimonial that really sums it up. 10x return in 5 days. In the 5 business days that I've been using Chaikin Analytics, I've paid for the subscription over tenfold. These initial results are nothing short of outstanding. Please extend my thanks to the entire Chaikin team, because there's a whole team of 26 people here in Philadelphia who are tied into your success, showing you how to use the system, answering your questions, there for you, because your success is our success. So in addition to everything we've seen, we have 2 market letters, my weekly market insights and my colleague John Schlitz's daily morning insights, which means that you don't have to be glued to CNBC all day to find out what's going on pre-market. Just read that morning insights. And then we have small group tutorials to help you get set up and use all of the features of Chaikin Analytics. So one final inducement to try and get you into the Chaikin community, 3,500 strong. If you subscribe by midnight tonight, we'll reduce the price of Chaikin Analytics an additional $100, so it's a $300 discount to $1,650. And for the first 5 people who call tonight, you'll get a one-on-one phone call with me. They typically last 30 minutes or more. Once you've gotten your onboarding session, so you know what Chaikin Analytics is all about. And this is the last time we're going to offer this for the foreseeable future, because as I said in mid-May, an exchange traded fund is going to be rolled out, trading on the NASDAQ, and my time is going to be taken up with that. So this is probably the last time we're going to offer this one-on-one phone call. So to sum up, subscribe by midnight tonight, get a price of $1,650. I know Joe Bacella typically puts that into the chat box. And first 5 people who call get a one-on-one phone call with me where you can discuss your trading problems, what you're trying to accomplish, everything short of specific recommendations. So with that, I'd like to thank you all and turn it back to Joe Bacella to close down the webinar.
All right. Thanks, Mark. Awesome. Well, everybody, thank you very much for coming out. As Mark mentioned, chaikinanalytics.com/earnings. I did chat that out into the chat window, so that may be blinking on your screen right now, which is great. Chaikinanalytics.com/earnings, or you can give us a call at 877-697-6783. Our support team is sticking around a little bit later tonight because I know a lot of you did have questions about some specific stocks. I think Arco was one that was requested. There's interest in a few others. If you give us a call, we can set up a live demo. You'll be able to see some of those stocks as well. I'm sorry if I didn't get to all of them in time. I know we had a lot of good questions coming through the chat box today, which is always great. Speaking of which, if we don't get your question answered today, if we have you subscribe now and take advantage of Mark's deal, we do have support webinars available every day. We kind of alternate between some of the more introductory facets of Chaikin Analytics. How do you get set up, create a watch list? How do you get familiar with the screener? But then we also have more in-depth, more hands-on sessions, including pre-market analysis webinars, as well as options trading webinars. In fact, we hosted one today, and the recording of that is available on our resource center right now. So make sure to take advantage of Mark's offer here, $1,650 for a full year to Chaikin Analytics, again, including access to all of those webinars, one-on-one sessions, and recordings. So we want to thank you all very much for coming out. Chaikinanalytics.com/earnings or 877-697-6783. Everybody have a wonderful evening. Keep an eye out for the recording tomorrow morning, and we'll see you tomorrow on our onboard session. Thanks.